Now 3 more ratios relating to sales. Let's start with the fifth one. Operating expense ratio. Operating expense ratio is equal to operating expenses upon net sales into 100. This shows what portion of sales is consumed by the operating expenses. Operating expenses simply means the expenses that reflects in P&L account. I hope now you all are getting slow and steady grip on this particular chapter. I hope. If not, then I am teaching really very bad. Operating expenses is done. And at the end of this 2 more formulas, I'll give you little more grip. So let's rush. 6th is equal to selling and distribution expenses ratio. The formula is selling and distribution expense upon net sales into 100. Again, this shows what portion of sales is consumed by the selling and distribution expenses. Okay. So you all might come to know how much the company spend on its selling and distribution expenses as compared to its net sales. Okay. 7th is equal to operating ratio. Operating ratio is very important. Why? Because it covers COGS plus operating expenses upon net sales into 100. That means it is covering trading account as well as P&L account as compared to the net sales, and we are finding out the ratio. That is the total expenses, that is the debit side of the trading account and the debit side of the P&L divided by net sales. Okay. This also shows the portion of total expenses as compared of total expenses. This also shows the portion of the total expenses consumed by this expenses as compared to sales. Hope quite clear. Please pause the video and copy this much first. Please pause the video and copy this much. I hope you all have copied. Now let's see the importance. If you want, you can write net sales over here because it is all related to net sales. The most important thing I am going to say is why these formulas we are learning. We are learning because if the question is providing you the balance sheet, it might be possible that the question is also providing you trading and P&L account where the figures are missing over there. So you have to find out the missing figure like this. If sales are given to you and all COGS are also provided to you, so you can easily find out GP, and there are many hidden things. You'll come to know as and when we are solving the sum. We will be able to calculate the COGS. We will be able to calculate COGS directly if net sales is provided. then net profit also. Okay, I hope you all are understanding the importance of this ratios. I have no words to explain this right now because these are all technical things which are directly applicable when we are solving the sums, which does not need explanation. So I think I should skip this part, and I have small more ratios. Let's move on to that. First is debtors turnover ratio. Formula is credit sales. Underline this or make a box. Credit sales divided by average of debtors plus bills receivable. Why this average has came, we'll come to know when we are solving the sums. Average because the data might be given of 2 years, then you have to calculate of 2 years, and two columns are given in our schedule 3, how it is given current year and the previous year. So similarly 2 columns are given, so you have to just take the average of both the years, that is previous year and the current year total divided by 2. Same for bills receivable and same for credit sales also. Average you have to take. Oh, okay, just a second. Not for the credit sales. Credit sales you have to take for the current year. I'm sorry for that. What is the importance of this ratio? This ratio helps us to calculate number of times debtors have paid back money. Okay, this is very important. Higher debtors turnover ratio, the ideal is the company. Okay, so you can come to know if the debtors ratio is high, then the company is good. If the debtors ratio is low, debtors turnover ratio is low, that means you can easily come to know that the company's managers are inside trading inside. That means they are taking the loan from the company and they are not repaying it back. Okay, or something on the similar line. Second, collection period slash debtors velocity, which is equal to 365 days slash 360 days. 360 days in case the question specifies slash 12 months divided by debtors turnover ratio. This ratio helps us to calculate the interval in which the payment is received. Okay, it will be ideal if you please pause the video and copy this much first. I hope you all have copied this much. Third formula is creditors turnover ratio. Similarly, it will be credit purchase divided by average of creditors plus bills payables. Please write it in a full form, bills payable. This ratio helps us to calculate the number of the creditors. Okay, I'll write better giving you the reference. This ratio helps us to calculate the number of times creditor slash company has made payment to its creditor. or better, we'll cut the creditors over here. The fourth ratio is again payment period slash creditors velocity, which is equal to again 360 slash 365 days slash 12 months divided by creditors turnover ratio. This ratio helps us to calculate the interval in which the payment is made. I hope this is quite clear. Please pause the video and write it down.